Okay, very good afternoon to all of you. Like every month, we will be starting our monthly market outlook. As we speak, we are seeing that market are getting a little bit of fluctuation in the last couple of days, basically because of might what Trump has said in the last 2 3 days back about inputting a tariff on rice. So those are the couple of factors. But today we will try to figure out what the data is saying as far as the global economics goes and what the data is saying as far as the market ahead is going, so that you can take an informed decision of the investments that you're holding or about to invest. Okay, so our structure will remain the same. We'll discuss about the global different economics. We'll come back to the Indian economy, and then we'll discuss about the Indian equity market, debt market, gold and silver. And in a process we'll discuss about the potential opportunities that lies across. Okay, so we'll move on. As we discuss the global economy, we are seeing that the most economics have seen a moderation in inflation expectation. If you see the data, this has been data taken from the March 2020 till date. Now you see the data across, and there you can see the inflation moderation. This is the India line, that's red line, which is going down, whereas US is showed to be on a stagnation phase. But I have a little doubt about how come the US inflation is at a stagnation phase, and even US has done a rate cuts 3 times this year, so which is a bit strange considering inflation, which is data which has been showing in data, and as far as what exactly happening in US. So you might be having your clients and known person in US, and if you ask them, the normal inflation there is high, last 5 6 months or 1 year, and so ever since this tariff has imposed, the normal things purchase price has gone up like anything, but still their inflation data is coming flat, and basis on that they have cut 3 times in interest rate. So which is a quite strange, but I'm not getting into those details. But overall, this is the data which normally every government publishes, and which shows that inflation is on a moderation stage across the globe. And likewise, we are seeing that there are a lot of stimulus packages which is giving across the world. Like US is preparing for $2,000 stimulus, China, and across all global economics they are giving the stimulus package. Okay, and that's the things that is happening. Government debt is projected to keep rising. This is the numbers. G7 economics gross government debt as percentage of GDP, including IMF projection. This is expected to keep rising. Some companies look safer than the government. Now, basis on the money supply, basis on the government debts, if you see the data, yields and current underlying government benchmark yields, so some companies, corporate bonds are looking much safer right now as far as the government yield is concerned. Global central bank to reduce monetary easing in 2026. So annual bank policy rate cut, although it is happening in 2025, you are seeing, and which will able to see that going ahead it will reduce uh, in 2026 as far as the projection right now. Global growth is expected to slow but stay positive. So this is the expected GDP right now, and this is the 26 GDP, and the inflation figure adjacent to that. So if you see the India figure, they have expected GDP 7.2, and this year and next year 6.3 lower. But surprisingly, last quarter India's GDP number has come above 8, which is way beyond what this number is. So this is a projected number. We will see what happen in the days to come. Interesting, India's inflation projection is way much higher than what we are having right now. Well, we have to see whether this data is relevant or not in days to come. So this is the data which has been projected, especially by the HSBC report. We have taken the report from here itself. So that's the data point which is coming up right now. Key risk for global market, that is AI bubble, mother of all AI, stock market bubble, US-China conflict, inflation, return stagnation, debt concern, fiscal deficit, dollar crash. So this is the risk which we all know. AI bubble, what I am saying, that the most of the AI company stock globally has skyrocketed like nothing. We have seen during the subprime, we have seen during the IT boom in 2001, huge amount of stock price surges because of the expected potential of the particular sector, but they didn't collapse. So if you see the AI stock prices globally, they have also skyrocketed. If it do not match with the expected line, then it will definitely fall. That's a global risk that we are having, and we know the inflation risk is there, and debt is already rising, as I showed in the earlier slides, and US-China conflict is also there. Japan 10-year bond yields near multi-year high. So that's the data itself says so. So that's what exactly about the other economy, and let's discuss about the China's economy. China's fiscal stimulus remain high. So this is the China fiscal stimulus. If you see the data, they are remaining at a high elevated level. Uh, Now, China has its own Ladli Bahana scheme. Now, if you think that only India has given the Ladli Bahana scheme, you know the Ladli Bahana scheme, like every year before the government, before the election happened, the government used to give this Ladli Bahana, free, packages to the female participant of the voter, and so that they get the vote share and populist measures kind of thing. So this thing is already China is also doing the Ladli Bahana scheme in a different way altogether. See the kind of scheme that they have, the other social security and employment, transfer of social insurance program, health education. So over the years 2004 till date, it has constantly keep on increasing, and that's what happened because you need to keep your public satisfied with those things. So that's is China is also there. Nearly 8% of their total GDP spend is on these largely Bahana likable schemes in China also. China has been investing too much for too long. China's excess capacity remains significant, while UK and India have largest good trades deficit after US. So if you see this, China's has still has a large excess capacity. So that's the data itself showing that. China witnessed low inflation and deflation kind of thing. So this is China. If you see the number here, they are in a deflationary trend, which is dangerous. Inflation is still now it is better, you can manage it, but deflation is much worse. So that's what China is going through right now. China market has done well over the last 2 years. China's export strength hasn't translated into stronger corporate earning. So although China see this export number is increasing, but their corporate earnings is not that great. So with saying this data, like export is growing, but the corporate earning is not growing, and then you have this data point as China's equity market has performed for the last 2 years. This clearly tells us that see the correction has started coming up. So these 2 years they have been in a run. Why these 2 years are coming in a run? If you see the numbers from here itself, for the last 10 years China was very flat, and then last 2 years they have started moving up. And now when the numbers of corporate earnings being flat and the export rising despite that corporate remain flat, so you will find that China's market will also come down to a realistic level. Will China's sixth mega equity rally end like just that's what I exactly telling you. That China's equity has been rallying for the last 1 or 2 years. If you have invested in China in last 1 or 2 years, you will double your money. But it is going to be, I guess, it will going to be flattened right now and will correct it to match up the numbers which we are telling you in the last slides. Learning from China, pivot to the future. So YOY change in outstanding loan by sector. So this is the industrial sector loans. This is a real estate development loan. So that's the loans is exactly there. Loan growth has been slowing down here itself. Leadership is more important than return. Outside housing, the decline in China capital productivity is unabated. So even in housing sector also, you see that real estate developer loan is reducing, industrial sector. So if the loan is reducing, then the credit growth is reducing. That itself tells us the story of our industry. Okay, so outside housing, the decline in China capital productivity is unabated. So this is the capital productivity, China's marginal product of capital with or without housing. So that's also been declining. But China has been achieving leadership in key technology. China has achieved a key global leadership position in 5 technologies. That is unmanned aerial vehicle. So if you see, they are global leaders: solar panel, gasoline, high-speed rail, electric vehicle, lithium. So many of this sector, which are interesting sector, they are becoming a global leader. Even in artificial intelligence, robotics, semiconductor, they are competitive, and they are going to be a global leader in days to come. So that's a very key interesting thing, because despite the despite growth in economy, growth in export, their earnings are slowing down, but they have a very high competitive advantages in many of the sectors which are going to be the key sectors in days to come. Okay, so that will actually safeguard their economy and take it to the next level from here itself. China's growing share of global drug research, and that is another thing. In drug research, we have seen that India was also very good in drug research. See, this is the India number. This is the India number, and but what is exactly happening is that China has been absolutely gaining control over this thing. So US is there, you have the China is there. European Union is coming down, and then you have a China, then you have a India. So those are the sectors, small sector, but China's drug research, innovative drug research has been growing up for the years. So the key areas which are interesting in days to come, China has been advancing like anything. Anti-corruption cases are reaching also new record high in China. So that data has been telling you. China has built most innovative economy through Sam Dam Dandvet. So that's a name which we have given. Like, so if you see, the China narrows the R&D gap with the US. So that's, I just highlight the point. I cannot go through each and every slide. It will take a longer time. So the China narrows the R&D gap with US. China target high tech manufacturing. China's industrial firms have ramped up their R&D efforts over the past decades. China has increased the output of the new productive force. So this all data point actually tells us that the areas which are going to be in a pipeline or hot areas right now, China is already in a competitive position, or they are going to be a market leader in those areas, and that will give them a huge competitive advantage going ahead. So that's all in China. We have seen a very mixed kind of thing in China. Although the export are growing, despite those tariff measures, their earnings has not grown. China's loan is also increasing, whereas the China's loan means government loan is increasing, whereas the real estate and other things are decreasing. Uh, but China is increasingly becoming market leader or a competitive advantage in many of the key sectors that world is moving to, starting from artificial intelligence, robotics, semiconductor, and many of the areas, drug research and everything. That will give China a very big advantage in days to come. Okay, so China's market for the last 1.5 years has grown, but the numbers which we are expected is that they are going to be corrected a little bit because of the factors that the corporate earnings are become stagnant. So let's see what exactly happened in US market. US stock market driven by tech, health, and luxury. If you see the data point here, till 1850, US market was driven by bankers, financial state of capitalism, financial market. There was a physical connection, infrastructure, and railroad till 1910. Until 1980, we have the age of basic and physical needs. Now they are booming into tech revolution, luxury, and health. So that's all the sectors where US, because we all know the G7 companies, the magnificent seven companies which the US operates, actually controlled 80% of the US stock market growth. Likewise, so that's what is happening in US. Driver of growth acceleration in 2026. So if you see the growth, Fed policy tailwind from 2025, rate cuts, we have seen fiscal policy, trade policy, and deregulation, tariff, rate cuts, corporate tax break, and deregulatory agenda. So those are the things which actually US government expect that they will keep the market like this in going ahead. We see the Fed policy, fiscal policy, deregulation, fading tariff, trade bills, all contributing to growth acceleration 2026. So if you see the US stock market growth is humongous. This economic drivers stand in addition to an ongoing structural tailwind from AI prominent in 2025. AI driven capital spending has been a major contributor to real US growth. So that's the thing which we are going to now. Interesting thing, if you see the AI driven growth in India, there is no AI company in India. Okay, so we are only using those services from the US, and we have seen a phenomenal growth in AI driven across the world. Even I was reading an article yesterday by Elon Musk. He was saying that SpaceX is planning to have an IPO next year. Now, if that thing happen, it will be in a $1 trillion IPO. So he will be managing $1 trillion IPO in $1 trillion company, two company by one person. Like, one is, we all know, the Tesla, and then we have the SpaceX. And SpaceX is planning to have this major AI data center, not in world, not in Earth, but in the space. So that's up with the money that we are planning to mobilize via IPO. That's a huge booster for this, a different level game altogether. We have seen that Google has taken a huge data center in Vizag with a huge billion dollar, $15 billion investment. So imagine what SpaceX is going to do with the AI data center in the space if they come up with this thing. So that's what I'm saying, that US AI driven growth has been majorly because of which the US growth has been continually over the last couple of years. And if you have invested in US stocks, couple of offshore stock, if you have invested, you have seen the kind of return that you are getting. And those return US stocks are majorly coming from the magnificent seven top companies, like this Apple, Microsoft, Alphabet, Facebook, Google, and all those companies, top US companies are coming. So moving ahead, AI stock were corrected sharply. Having said that, AI stock have been on a tremendous return for the last couple of years, but it has corrected sharply, and that is also the rule of the stock. Like when the stock is very promising, it goes up like anything, and after a point of time, if the returns are not as per the expected line, it's corrected sharply, and that is better for them also because. If they have a corrected sharply, then we better chance of getting entered by the investor at a lower point of time. 26 earning estimate for the Magnificent Seven shoots up, S&P 493 shoots down. So that's what I'm saying. Like Magnificent Seven, you see that this is the Magnificent Seven. 26 expected earning at shoot up at 20%, whereas the S&P 493 companies, they have a shoot down. So that's the kind of thing. Like these seven companies contributes about 80% of the S&P, and they have a higher chance of EPS growth in expected in coming 2026 also. You can US manufacturer produce more. US manufacturer capacity is expanding. Lower capacity utilization may be constrained by labor. So labor is another, yes, is a big problem on the US because of the tariff factor. They are coming up with new and new regulations where it becomes difficult for the foreigners to work out there. And also the US labor, the unemployment data has been coming a little bit stagnant kind of thing. Last couple of years, couple of months, there have been a huge unemployment problem in US, but of late it has little bit slowed down. The data point itself. So the labor problem is there, and that will actually be hindrance towards US manufacturing capacity expanding to bit. Will tariff burden shift to the US consumer? It has already been shifted, despite the data is saying if you have known person in US, you will able to know the kind of cost they are incurring on daily necessities, food, commodities, and other things. But the data suggests that this data is basically till September. So this last quarter is very important for the US because of the Christmas time, and they used to buy gifts and everything. So this price has increased. Now they are saying that it is been mostly been moved towards by the consumer and the foreign exporters. Although they are saying that this will be absorbed by the US business and the foreign business, but no, the fact is on ground is the consumer is getting affected by that. And as I am doing the session today, I've seen in the today morning that in the couple of senator out there, they have put a resolution in the US Parliament that to take back the 50% Indian tariff. Even the Brazil have also, a couple of senator has also put a resolution in the government to put up, take back the Brazil, this trade policy also. Let's see what's going to happen in the US Parliament in days to come. But that's what is happening, because when the senators, they put on some regulations, put on resolution into the Parliament, this normally happen when there is a public pressure. So that's what is happening in US. So let's not get into what will happen there or not. Our purpose is to show you the data and to decide what exactly is going to happen there. US job market shows sign of weakening. That's what I'm saying. The US hiring rate similar to level typically seen during recession. Wage growth has been slowing gradually. So this is the US job hiring segments. This is August 2020 and August 2025. So that's the thing. US job hiring rate has been declining. Okay, so your wage growth is also slowing down. Local presidential approval rating is low. This we all know that is presidential approval. Trump approval rating is low now. US debt has remained elevated. This number, which we have showing you for the last 2 to 3 years, has been remained elevated till now. In 2025, the US twin deficit will total around 11 to 12% of US GDP. So that's the huge number that we are saying here. Dollar weakness leads to money flowing out. Foreigners own a lot of US assets. So this is the US equities, 18.5 trillion, like 20% of the foreign Indian US equities owned by foreigner. And out of US Treasury, 30% of total US Treasury owned by the foreigner and mostly by the Chinese. Okay, so that's very interesting data point. That's why US can't do much, no strapping or can't do much tight handling with the China itself, because they know 30% of this major tariff has been held by them. So if they start selling, US dollar will have a big problem. Indian economy. So that's what is US economy we have seen, though they are still in a problematic phase as such. But the top Magnificent Seven, they're holding up because they have been outperforming the market driven by the AI. So let's see what happened in the Indian economy. Indian real GDP growth scale quarter high of 8.2%. We already told rupee hit all-time low, slip past 90 against US dollar. Now, despite India is in a global, oasis kind of thing, rupee is getting depreciated. Why? Because one reason is that there are a lot of outflow happening from India. When there is an outflow happening from India, that put pressure on the dollar and rupee, and that's why the rupee getting depreciated. Why the outflow is happening? We have seen that in US, the tariff issue is there. They are giving a lot of privilege, a lot of incentive for the US companies to do business in US itself. So those factors and Trump other factors is there. So that's why a lot of US companies are moving out of India. The FII especially. Although the big seven, they have talked to the Narendra Modi in last couple of weeks, and they have promised to invest in India in a bigger amount, but that will come later on. So that's what is happening. Plus, secondly, because of the AI revolution globally, there is no such Indian company there who are into AI kind of business. So most of the of FII, they are moving out of India and investing in those AI-driven company, which they expect is going to be a game changer in days to come. So that's why they're investing in US and Europe and other where there is a AI driven business model is out there. So those are the couple of factors which there because of why the rupee is going past 90 and depreciated so much. GST correction rise to a slower pace. In the inflation is lower. IIP growth slumps to a 0.4% in October. The output weakens. India is fiscally prudent. So if you see the different data point, India, Germany, France, Brazil, and etc., core dates of non-financial sector. So if you see the number out here, India is well poised vis-a-vis any other developing nations. Okay. Market re-rated India. Just quickly, moon per capita GDP growing faster than the Asian peers. So this is the per capita India in India. Adverse impact of unjust US action. This we have said last month also. Textile, aquaculture, gems and jewelry, handicraft. So tariff hit hard due to high labor use and narrow profit margin. Export to the US fell in September, while that to the rest of the world rose. Okay, so that's the data point. Like more and more export to the US will come down, and the rest of the world will keep on increasing. So this is the US, and this is the rest of the world. So that's what is happening. It is from here it has moved up. So as we move ahead, we have seen that the Putin has come in last week, and we have a lot of trade negotiations and trade deals that happen. So India is aggressively pushing trade deals with different other countries rather than outside the US. And if you see these numbers in days to come will go much higher, and this number will stagnate a little bit and will so that will actually help us to diversify our export to different countries. Now, depending too much into one country is not better. We have seen the same thing in last week Indigo fiasco also. Like 70% of the Indian skies for domestic skies is driven by the Indigo, and that's why what happened. So in export also it's same thing. If you can't depend too much on US, so this thing I will say a good thing has happened because of the tariff. Now Indian government itself, they have rose up, and they will move on to the other world, other countries to expand their export base to those things, where so that the we so that the percentage share of one country will reduce as far as the export is goes. That's a better for the long term perspective. Yes, in a shorter term, these are the sectors which you highlighted, they will have a problem, but going ahead it will have a better chances that as we diversify across different countries. Indian strategic response, like what apart from diversifying to other countries, what India has done is that stimulate domestic economy. Income tax rebate, GST card, interest rate card, 8-pay commission. This is a couple of things we where that has been going on. We are alternate export market. I already told you ban on gaming, credit guarantee schemes, and obviously the negotiations going on with US. So those are the things which Indian government has done to counter the term tariff factors. Okay. Indian share in export is rising despite. See, this is the interesting. That's why I'm saying that despite US tariff, Indian share in export is rising despite US tariff. So that's what is happening. World goods export uh, share and the world goods service export share. So that is the number. So that's, you have seen the number here itself. GST cut and festive demand lift retail sales 11%. So October YOY in August to October 2025, and even this quarter, like October, November, December, will be higher because we have the monsoon season and we have a big wedding season coming up. So India has been a huge driver of this wedding season, and huge consumer expenses happened during that time. So last quarter results was bit of flat, but we still have a higher GDP numbers coming up, and this higher GDP number will actually reflect this quarter plus next quarter results. So that's why the all the Indian equity market, if you've seen a stagnation at 84, 85,000 levels, Sensex for a long time, because our earnings was very stagnant. I am going to show you the slide in next couple of time. You will a couple of slides. You will find that the earnings, the last 3, 4, 5 quarters is very stagnant. Now, if you have a earnings stagnation, you don't expect the market to go high, because price to earning ratio is always has to be maintained. And but last quarter results was good. You have seen that from the GST number, and this quarter we are also expecting good December quarter, and then we have the next quarter also. So these three combined quarter results will be better. So 2026 mid and later half, or 2027 beginning, we're going to see a much better numbers as far as the earning goes, and then we'll have a next boom in the Indian equity market. Now, another interesting point is given to pause there and say that to from the market to move from 85,000 to the next level, the the FI investment has to be there. Now, FI investment has been stalled. FI investment is stalled. The reason because I have been saying the couple of reasons why there is no AI driven company in India. The FI have been moving out of India and investing in AI driven market. Second, the yield difference is very narrow. The US interest rate right now, although it has reduced in last 3 quarter, is suppose say for example 3.5 and 4%, whereas the Indian interest rate is also reduced because of the low inflation, it's 6%. So in US the interest rate is 4%, and India interest rate is 6%. So the gap in yield is only 2%. So why a US investor will invest in India when the gap is only 2%? In a conversion of INR to rupee, INR to dollar, this will actually eats up. Remember in 10 years back when we used to have a US bond yields nearing about 1 to 2%, and Indian FD or government bond yields 8 to 9%. We used to have a 6 to 7% yield gap. And that's why it makes sense for the US investor to invest. Now, when I'm talking about US investor, the corporate investor or the government investor to invest in India, we're talking about the bond market, not about the equity market, where the huge amount of money flows. So one, not AI driven company much in India, but there's a huge opportunity. Second, the bond yield market, bond yield spread is very less in India, and that's why they're not coming up. And third factor, because of the tariff and the concession that the Trump is giving, so that they put the business in the US itself. So once these things stabilize, already they have done a rate cut 3 times just to boost up their economy. India is also having a little bit of inflation, lower inflation. Once this spread increases, then we'll see again the FI money coming up. And secondly, the tariff thing settled down. We have just now I mentioned that there was a resolution put on in the US market, US Parliament to pass to remove those stamped, tariff. So once this thing settle down, you will find the FI coming up. Without FI coming into India, you should not expect market to move up, 1 lakh or 1 lakh, Sensex to move up beyond 1 lakh, or Nifty to move beyond 30,000 level. And third and the last one is that the earnings. So if you see the earnings data, it's been very flat from the last couple of months. So once this earning moved up, as I said, for the last 3 quarter, then actually the price will also see movements. So there are three factors. One is the earnings has to move up, which we expect the earnings will move up from this or next quarter. Bond yields, well, that is the difficult question. We don't know when the bond yield spread will increase. And third, the AI driven, that is also not happening. So one thing is important is that we have to look for the spread in bond spread, and secondly we look for the earnings, which is expected to be better. So wait for another 6 or 8 1 year kind of say, then I can expect this earning expectations to come up. The earnings will increase, and when the earning increase, the market will move up from here. So it's a good time to accumulate your assets right now at this level, so that in next 1 or 2 years kind of thing, you will get the results from here itself. Okay. Also, interesting data point is that if you see the last 5 years data in Indian stock market, in a sense that if you put the last 5 years S&P small cap index India, you will see the 196% return. Okay, so that's like 40% return in last 5 years annual small cap segment in India. But if you see the last 1.5 years return, 1 year approximately return is minus 40%. So the most of the return in India has come in the last four years, like 2021 to 2024 end. And last one is more of a flat, on some segment it is lower. So it normally happens like if you have a last 5 year return as 40% annualized return, then it has to be corrected to price earning ratio level itself. So that's what is happening in India. If you see that your market is not performing for the last 1 year, don't see 1 year, see for the last 5 years. 5 years has been phenomenal. Just because of last 1 year was flat, and that's why. But the previous 4 years was a phenomenon. That's why you're seeing the market getting stagnant at that level itself, the Sensex and Nifty, vis-a-vis, and also the FI are not coming up. So that's combined by these factors, market is been stagnant. So moving on, I'll just keep a little bit of our Indian market also as I speak. Second quarter GDP, this we are talking about India. Second quarter GDP growth come ahead of expectation. As already told you, strong rebound in manufacturing. Rural wage is improving. Consumption growth to remain silent. I just quickly move on. Domestic demand to drive growth. So I already told you, like domestic demand will always be remain in India, high in India. Flattening in central government capex in the last 2 years. Capacity regulation has not peaked and can boost operating. Environment conducive of capex to revive. India Inc. has started announcing capex. So that's the data point we have seen. The announced project worth of 15 trillion rupees. That's a huge number. Okay. So that's saying rupee hits a record low of 90. I told you why, the reason of that. India needs to leverage INR depreciations for export. GST collection lower than expected nominal GDP. So that's what happened. India role in rising global economy. Contribution to global GDP growth, Indian share in global GDP. So that's the number which we are seeing here. So India rising. So that's a contribution to global GDP. So if you see the number from last couple of decades, India is constantly increasing here itself. So that's what is happening in Indian economy. Indian equity market, well, just quickly move through. India's Nifty 50 index hits record high level after 14 months. So that's the record high level that we are talking about, 26,000 level. Benchmark marks broader market weakness. 73% Nifty 500 index stocks are still down 10% from 52-week high. If this is the important data point, that's why I'm saying as quickly move on to the other data. Take the FPI seller. So this is the number. This is the FPI. FII equity has been constantly moving out. Okay, so this is that YTD, 2025. 2024 also is negative. 23 is positive. Now see the domestic investor, the huge, but net this year it's already FI has withdrawn a lump sum amount. So that's the reason market is not moving up to the next level. So that's what is happening. And Indian market cap to GDP has remained elevated, which is every show you every month. MSCI India index has underperformed hugely in TD. So that's the India index. Why? Because India has been stagnant for the last 1 year. But if you see this data for the last 5 years, the India will outperform many of those countries. Okay. But last 1 year, I told you why India market is even stagnant. Earnings were stagnant. That's the numbers. As I said, the last 1 year, Indian market was stagnating. Why? Because see, the earnings were stagnating for the last 6 quarters. You see the Nifty 50 index PAT growth and PAT for the MOFSL universe 15% YY. So this is the growth. See, this is the growth figure. So Nifty 50 PAT, profit after tax, YM growth. So last 6 quarters, it has been stagnant. Now, if you have a growth like this, then the market, that's why I'm saying from 2020 to 2024, we have seen a humongous return. But see, the last 5 quarters, it's been more or less stagnant. 2%, 3%, 6% growth is very less. Earlier, we used to have a profit growth of 15, 20, 20%. That's why we have seen a huge growth that time. So remember, until unless you have a bad growth coming up, you don't expect the market to move up. So this number will definitely rise, as I said. This quarter, last quarter, GST results was good. That means the market has done well. Top line was well. So this quarter will also be well. So couple of quarters are coming up very positive. So this actually will reflect in 6 months and 8 months down the line. So then you will have a better growth prospect coming up. Okay. So moving on, FPI holding in an equity market dip further. See, this is the number. So we used to have like 20-21% FPI holding. Now it is only 15%. Until unless if this reaches at this level itself, 17-18% level itself, that 2.5% or 3% higher from here itself, then also the market move up like anything. But to move from 15% FPI level to 18%, like again the FI coming back to India, that requires couple of points which I've already told you a couple of times right now. Active FPR underweight India by 3% below benchmark, right? So that's I told you like fear versus FOMO. I just want to go into India is starting to offer value versus China. Like, see, this is another interesting data point like FTSE India index versus premium to China. So that's thing. See, the China, what is happening is that the Indian price to earning ratio, which you're going to see in next couple of slides, it's normally Nifty PE ratio is like 2021. China 1 year back price earning of China index was around 9. So if you are an international investor, tell me where will you invest? You will invest at a P ratio of 20 or will you invest in a P ratio of 9? Obviously 9. That's why people invested in China. China today is at the P ratio of 16 to 17. Like it is still cheaper than India. Okay. So that's what happening. So Indian valuations are for the last 1 year because of wind stagnation it's become a stagnant phase, and China has also increased but still is getting at a cheaper rate. So that's what is happening, these things, but the gap has narrowed down and India is getting little bit in a better advantage as far as the overall goes. So the gap is narrow as far as the price to earning valuation goes. BRICS becoming bigger than G7, so that's the right GDP at PPP percentage of total ratio of MSCI emerging market S&P lowest. Earnings set to recovery. I told you, I just told you in a couple of slides before that earnings set to recovery in FY 2027. So that's the thing. That's when you have the earning recovery happening, market will boom up like from there itself. And obviously, when you have a better earnings, the FI will also look for those earnings. So normally, the big FIs they actually look for the earnings to invest. So then they will come up by this thing. And once the FIs start coming up, seeing the earnings, you will have the market boost up like anything. Without FI coming up, don't expect the market from here to move up like anything. Okay, it will go very narrowly, slowly from here onwards. Led by consumption, bank, and cyclical. Why the earnings will move up? Like this consumption, bank, and cyclical. These three segments we expect will drive market India from here on. Nifty 50 index is trading close to long-term average. So if you see the Nifty, this is Nifty 50p ratio. Long-term average is trading near long-term average. This is mid cap, and this is the small cap index. So only Nifty 50 is trading at long-term average. So you can see that the large cap basically are at exact valuation that they should be. Mid and small cap are still very costly right now. So, sharp surge in primary market activity was driven by IPOs. A lot of IPOs have come up in India, so that's what is happening here. Be ready for volatility. Well, these slides always remain in every of my presentations because once you deal with equity market, this has to be. Many stock are delivered return. So just quickly move on. Expensive valuation. Many stock are trading in expensive valuation too. So if you are investing in stocks, be careful about what valuation they are getting entered. In a couple of days before, we have a Lenskart IPO and we have a 230p and a lot of investors invested there. So if you're buying at a stock at 230p, don't expect your money has gone down or you have made losses. It is your fault. So look at the valuations before investing in direct stock. And if you are looking for a mutual fund investments, there are a couple of avenues out there. Large cap, yes, they are at a fairly price, but it will not give you a huge return. So if you want to get a bigger return, look for the multi cap or flexi cap options of mutual funds or stocks. Then look for the valuations. If you're investing for the valuation, you can connect with me separately and discuss about your portfolio in as far as the valuations and your expectation goes. Okay, so I'm not going to discuss any particular stock or mutual fund scheme in open forum like this. The SEBI bards me to tell about those things. This session is anyway for your information about the market. So, but if you are looking for investment for stocks, definitely look for valuations. And if you're looking for investment mutual funds, I will recommend you to look for flexi cap and multi cap segment or multi-asset funds where you have an exposure to gold and silver also. Because once you get into the silver and gold segment, you will understand despite they have risen for too much, there are huge opportunity there lies also. Moderate return expectation. So I told you about neutral to equity. I told you, so equity investment opportunity I've already discussed with you. And right now we'll discuss about the Indian equity market. We'll discuss about the global equity, US market and China market. Now I'll move to the debt market. So debt market, I've already told you that the inflation has been broadly stable, but I am very fictitious about the data which will be provided by the different countries, especially US. So I'm not going to discuss about, because I can't do anything about it. The data which we are showing, we have to show it to the people. If Fed rate, so they have been reducing interest rate for the couple of quarter by now. Um, so RBI revises inflation outlook downward to 2% to 2.6%. Now, interesting data point. Now here, the source is from RBI. Okay, RBI say that in FY 2026 the inflation will be 2% from the 2.26% right now. But if you remember in HSBC slide, which we were showing that they are expecting India's inflation to move from 2.6% to 3%. The every each other data point differs. So that's what exactly you have to understand. You have to read the data from the macro perspective and different other perspective. That will actually help you tell you what exactly is happening. So RBI expected Indians inflation to go down from here itself. RBI lift India GDP forecast to 6.7.3 from 6.8%. Again, the data which is shown by the global player that Indian GDP will be stagnant, but RBI has already showed it that it will grow from here itself. So, though different contradicting data point, RBI big liquidity boost of 1 lakh crore OPMO purchase. Bloomberg index exclusion positive to give a bond market a strong push. Yes, that's a big point. I am not going to do this thing. So debt market opportunity. Well, already we have a 3 rate cuts happening with the US and 1 rate cut in India, and I don't expect near rate cuts in happening in India right now. Although the inflation didn't stabilize because of the rupee factor. So if you are looking for a debt investment opportunity, go by the dynamic bond fund, where they can have an advantage of moving in short term and long term yields kind of paper plus arbitrage opportunities. So that's where you can get a better return than normal bond itself. So that's it. And gold investment, yes, gold and silver. Well, gold and silver, we have been seeing a phenomenal rise in the gold and silver category. But gold, out of total world available gold, 23% of the gold are still to be mined. So there's an opportunity in gold. And why gold has increased? Because that's a different story altogether. It will continue to increase whenever there is a dollar, pressure around the world, and whenever the countries are fearful of the US dollar. So that's why a lot of countries are accumulating gold like anything, and that's why gold price has increased. Silver, I will say that it has a huge industrial exposure and demand. And recently, the UAE government has started accumulating silver. So that's why silver price has moved up in last 1 month. So that's why it has increased. So again, I will tell that gold and silver, take it as a strategic asset class. If you have 100 rupees, definitely put 10 rupees minimum in gold and silver plus 5, plus minus 5. You can go up to 15% max, but don't go overexposing gold and silver beyond 15% level. So that you can put into. Silver looks attractive. Yes, if you already have gold in your kitty, add on a little bit of silver in those category also. The next slides, the gold reserve pyramid to the 23% left to be mined. So that's why. And this geopolitical risk, I just quickly, China has continued to acquire gold. Demand for silver, that's what I'm saying. Silver has been running a structural deficit last 4 years, and a lot of demand for silver is there, because silver has been used in industrial production also. That's what I've said right now. This yes, the Saudi central bank makes a remarkable move. Silver might be benefiting Russian central bank buying. So that's what is happening because of silver. As a result, silver is increasing. Okay, so gold silver ratio indicates silver relative undervaluations. So I just see that can be a little bit of exposure in silver to be a better off, although its price has increased too much. Okay, but don't go too much aggressive in silver. You can have a little bit of exposure silver. Even via in mutual fund, you can take silver in a multi-asset route, not directly. So that will have a little bit of silver exposure anyway. Uh, so that's a couple of data from here. Financial service improving profitability, growth. So I just quickly move on. I already discussed about this. Okay, so that's all from my side today, and 45 minutes. So the sessions. So I just want to say that the data which we have presented to you, We discussed about US economy, China economy. We have discussed about Indian equity market and economy, as well as the debt market and gold and silver. So market from here itself, not very gloomy, because although the market has been stagnant, it rises a little bit and then falls down. But market from here to move on to the next level, we need FII numbers. We need FII investments. So the FII investment will only come back when we have the corporate earnings, which I've showed you. It has to increase for the FII to understand, the Indian market has some juice left. So that's one. And secondly, AI investment that they're doing aggressively in other market. If those AI investment expectation, a result is not meet expectation, then they will pull out the money from there and they look for other market to invest in. And if the Indian earnings get better, then they will invest in India itself. And third, the interest rate spread in US bond and Indian bond. So that is to also be looked up into, because that's a big money, government treasury money that's coming to the India. Which that's is been a little bit of halt because of the spread is not being attractive right now. So that's all from my side today. This is a good time for accumulation of your asset. Don't expect a huge kind of return in next 2 to 3 months or 4 months kind of thing. But last four, why? Because last 5 years has been phenomenal. In the last 5 years, last 4 years was phenomenal, last 1 year was stagnant. It has to be, because price earning has to match. So next 1.5 years will be, next 6 months to 1 year will be a little bit stagflation kind of thing as far as the market goes, until unless the FI comes up. That's a different story. But 2027 beginning, I'm expecting a very good numbers to come up with this number. Mark my words. So to keep on investing systematically every month. Don't go aggressively in any one particular month. And 1 year from now, or 8 months or 1 year from now, as we nearing to the 2026 end, you'll see the numbers coming up better way. Okay. Thank you very much. If you have any questions, you can drop me a message in my WhatsApp. And every month we have this session. So next month also we'll have a sessions and update you what's happening India globally as far as the market is concerned. Thank you.